Hi everybody, welcome to the video. Thank you so much for joining us here today. Today we're going to be talking about 3 terms that you'll need to understand when learning to trade options. We're talking about in the money, at the money, and out of the money. Welcome back to all of our subscribers, and if this is your first time here, my name is Kirk with Tactical Options Trading, and we make videos just like this on a consistent basis where we talk about the stock market, options trading, we talk about the Thinkorswim trading platform, we put on live trades here on our channel. If you haven't already, I hope you'll consider clicking this button right up here and subscribing. And while you're at it, click that bell so that you don't miss out on any future content. All right, guys, let's get this thing going. All right, let's go ahead and break these 3 terms down. We're talking about in the money. We're talking about at the money. We're talking about out of the money. We're talking about a lot of money, you guys. But seriously, though, when we're talking about trading options, these 3 terms right here are terms that you're going to hear a lot. In the money, at the money, out of the money. But really all that means is the relationship of where the strike price is in relation to the stock price. So in this video, we're going to be talking about calls and puts and in the money and out of the money. So let's get started by talking about the in the money call option first. So if somebody ever asks you, what's an in the money call option? Well, here's a definition. I'm going to tell you guys what an in the money call option is. So when the stock price is currently higher than the strike price, then that is considered an in the money call option. So if you are a holder of a call option, sounds pretty prestigious, right? I'm a holder of a call option. Well, the holder of a call option has the right but not the obligation to buy the stock at a price that is less than what the stock is currently trading for in the open market. Now, I'm going to give you guys some definitions here, and then we'll go through some examples, but I want to give you the definitions first to give you a little bit of a foundation before we start hitting those examples. So this would be an in the money call option. Now let's take a look at an in the money put option. That even sounds more prestigious, right? I'm a holder of an in the money put option. Well, an in the money put option is when the stock price is currently lower than the strike price, then that would be considered an in the money put option. So for example, the holder of a put option has the right but not the obligation to sell the stock at a price that is more than what the stock is currently trading for in the open market. So let's take a look at some examples of this, you guys. So let's look at the in the money call option example. So let's say the stock was trading for $60. We come in and we buy that $40 call option. We think we're pretty smart. We're going to come in here and we'll buy that $40 call option. That gives us the right as the buyer of that $40 call option. That gives us the right to buy stock at $40. So this stock has traded up. It's moved up. It is now trading for $60. We own the right to buy stock at $40. So in this case, because the stock is at $60 and we own the $40 strike, we would have $20 of in the money. We'd be in the money $20 on this particular scenario. So we have some intrinsic value built into that strike price. We have $20. That'd be $20 in the money. Now let's take a look at out of the money call option. So you guys, from watching our other videos, you know that we can sell options, we can buy options. There's all kinds of things we can do with options. Let's say, for example, we bought an out of the money call option. We expected the stock to go up, and so we bought a far out of the money call option. So let's say, for example, in this scenario, we bought the $60 call option. The stock, though, is only trading at $40. We're expecting the stock to come up to $60 and then move on beyond that $60. We bought it that's really far out of the money. So we bought the $60 strike. The stock is actually trading at $40. Well, in this case, because there's no intrinsic value, there's no value in that strike price that's built in other than, just some extrinsic value because the stock price is actually lower than that strike price. We would be out of the money in this case by $20 until that stock price came up to that $60 strike and then traded above it. So if it's 1 penny above, it's $60.01, that would be considered in the money. But in this case, it's $20 out of the money because that stock price is lower than the strike price. All right, now let's talk about the put option side. Now this is stuff you have to wrap your head around. A lot of people understand the call option side and how that works, But when you're talking about the puts, that's a little bit different. If you're new to options, you might have to, think about this for a while. So, and in the money put option, let's look at this example. So let's say we bought the $60 strike. We bought a $60 put option. Well, the stock is now trading at $40. So if you remember what a put option is, it gives the buyer of a put option, it gives the buyer the right to sell stock. Well, if we bought the $60 strike, that gives us the right to sell stock at $60. So if the stock is actually trading for $40, well, we look pretty good right now, right? We bought the put option at 60. The stock is trading for 40. The stock traded down to 40. So we have some built-in value now into this strike price because we can sell stock that's trading at 40. We can actually sell it for 60. So that gives us an in-the-money value of $20. So we're looking pretty good right now in this in-the-money put option. Now let's talk about the out-of-the-money put option. So an out-of-the-money put option, let's say for this example, the stock is trading at $60. So if we're buying an out-of-the-money put, that would actually, we'd be buying that put below the stock price, right? So the strike price that we've decided to purchase in this scenario was $40. So in this case, we'd be $20 out of the money, because if the stock price is at 60 and we own the put option at 40, well, the put option gives us, as the buyer of that put option, the right to sell stock. It gives us the right to sell stock at $40. But why would we want to sell stock at $40 if that stock is selling at $60? So in this case, it's out of the money until that stock price drops below the 40, until we get down to $39.99. That would be out of the money until we hit that $39.99. Then we'd be in the money by 1 cent. So hopefully that makes sense. You guys, again, you have to kind of wrap your head around what these are when you're talking about the put side. So now let's talk about at the money. At the money, that's pretty simple. At the money means that the stock price and the strike price are exactly the same. So if you're buying an at the money put, you're buying a put right where the stock is trading at. If you're buying at the money call, you're buying a call right where that stock is trading. So let me show you guys, I want to show you guys on my Thinkorswim platform. The brokers or the platform will actually show you where the in the money and the out of the money calls and puts are. So let's say, for example, right now we're looking at Apple, and Apple is trading at $191.38. So the closest strike to that would be 190, right? So we're looking at this 190 strike. So anything below the 190 on the call side would be in the money. So you look right over here, everything that's shaded in yellow, that is in the money. And over here on the call or on the put side, everything that is above the 190 is in the money on the put side. So hopefully that helps you guys out to understand, you can look here on your platform and see right where the stock is and see where those options are, if they're in the money or out of the money. So guys, thank you so much for watching. I hope this video has been helpful. Please post your comments below if you have any comments, any questions. We love connecting with you. Appreciate you guys watching our videos. Like and subscribe if this video has been helpful for you. Would love for you guys to share it too if you found this video helpful and you think somebody else might like it. Go ahead and share it with them. Appreciate you guys watching our videos. Again, my name's Kirk with Tactical Options Trading. Have a good one, everybody. We'll talk to you later. Bye-bye.